Welcome to Holistic Accountant Podcast, where we aim to showcase how adopting a holistic approach in accounting and tax maximizes value for clients. Beyond traditional tasks like preparing financial statements and tax returns, a holistic accountant focuses on offering advice that maximizes personal wealth on an after-tax basis. If you enjoy this episode, please consider leaving a rating and sharing it with those who might also benefit. And to ensure you stay updated, subscribe to our weekly email. The link is in the show notes. Okay, so last week, Mena and I spoke about succession strategy and considering, what are the factors you need to consider in doing a transition strategy. So that really involves gradually selling down part of your business, eventually, hopefully all of your business, to people that work in it, how to attract people that are going to be perfect for that sort of role, and the matters that you need to consider. Today, what we want to talk about is the alternate strategy to that, which is really a trade sale, which is means just selling 100% of your business to a third party. It might be a related third party in terms of them in the industry, or maybe you've transacted with them, or maybe they're upstream or downstream to you in your own industry, or they could be someone, a competitor or someone that you've never met before. But the option is really, to some extent, a clean break.
So the first step is to establish who your buyer is. So we sort of refer to, there's really three main buyers of any business. There's firstly the strategic buyer. So someone that's a competitor within sort of the industry that wants to achieve scale or tap into your intellectual property. There could be a financial buyer, something like a private investor or a private equity firm that are happy sort of just to come in, make a few changes and sort of try to get some scale out of your business. So, of course, the motivations differ between whether it's an insider or outsider to the business. So, it's the risks involved here is selling to someone who doesn't necessarily understand the business, or someone that is just there to derive a profit. Now, of course, we're all here to derive a profit when sort of we're in business. We somewhat care about the staff, the brand, the legacy that we leave behind. So, when establishing who your buyer is, it's really important to establish what's important to you and what should be left behind of your business.
Next thing you need to think about is, what are you going to sell them? Are you going to sell them the shares or units in your business, or you'd be selling the assets? And what do those assets look like? Are they hard assets? Are they goodwill? If you operate your business from real estate premises, will that be included in the sale, or will there be some sort of lease arrangement? All these things, you need to think about firstly, how are transactions typically structured in your industry? And that'll also help you kind of understand what the tax outcomes are. Now, in most situations, people prefer to buy the assets of a business rather than the entity. And the reason for that is, as a buyer of your business, I don't necessarily want to inherit any legacy liabilities or potential liabilities that arise with your entity. So I'd rather then buy your goodwill and any assets, staff, employees, all those sorts of things, and then put them into my fresh entity, being a company or trust, and therefore not have any of those legacy liabilities. But in some situations where there's particular licenses that are attached to a particular entity and those sorts of things, sometimes it's the sale of the equity in that entity, being sales of shares in a company or units in a unit trust. And we just need to then think about what are the capital gains tax consequences. And was previously spoken about using small business CGT concessions and how you can utilize them. But that's something you need to talk about with your holistic accountant. And also the whole point of, recording these episodes is hopefully it's some way down the track. So if there's something that you need to do in order to restructure your business so that it looks as attractive as possible to a buyer, then you want to start that process as soon as possible. So that's why it's important to think about, what will the sale transaction look like from a structure perspective.
So let's talk about how to make your business sellable. So of course, if you're going to go down, let's talk about the private equity path. A private investor who wants to come in and make sure, that it's a business is tight in terms of strong systems, repeatable processes, and so forth. They're going to look into basically what your management systems look like and who your key personnel are. So they'll look at, does the business have a board of directors in place, or a board in place that advises around sort of the general operations of the business from a financial perspective, operating operating perspective, tech, all those kind of things that are relevant to your business. So it's really important to have these key personnel locked in with contracts and incentives, have strong systems in place, repeatable systems, and systems that allow you to account for each and every staff member. They want a streamlined process. They want to come in and, just take the keys and get the business sort of going from the get-go. If it's someone within your industry, they're probably looking at how they're going to achieve scale from your business. Are they after a particular IP? If they are, how are they going to structure that purchase? If they're after particular assets, it could be sort of business premises or certain equipment. How do they lock in that equipment and make sure that it's right? Making sure that the equipment's sort of repaired correctly, maintained correctly, and similar to that, does your IP, have, the relevant trademarks and patents in place? So it's really important to make sure that you're sort of operationally sound from that perspective. Now, the other thing that to really look at is your accounting policies. Just recently, we've come across a client who's in the process of, or was in the process of selling their business, but their financials, unfortunately, because they were so hell-bent on saving tax, that it didn't really show their true profitability. And as a result, their multiple or their maintainable earnings was shot. They couldn't really get the value that they wanted. So now they have to wait probably another 2, 3, 4 years to get the real maintainable earnings of the business so that they can actually sell it at what the business is actually worth. So it's really important that you get these processes in place from the start, because when you come to sell the business now, it doesn't mean that everything that you have in place now is the right fit and presents the best way it could. So it's all about future-proofing the business sale.
Which is a really good point, Mena. I want to talk about some of the sort of common pitfalls or tips or strategies that, we're seeing along the way. But I mean, as Mena touched on, that's the first point is, you've got to start planning this thing well in advance. And I would say that, every business owner should have, to some degree, an idea about what their succession strategy looks like or their exit strategy looks like. And the reason I say that is because it gives you context to help make any decisions. Now, not every single business decision that you make will have any relevance to your exit strategy, but you don't want to be in a situation where you make a decision today in 5 years' time, you look back and go, well, I wish I had structured that a little bit differently, knowing how I'm going to exit. So I think everyone needs to have a succession plan, and formulating that plan and then thinking about what we need to do over the next period of time in order to position you to maximize the exit value, I think is a really important thing to do. And it could be that there's not a lot you need to do over the next few years, which is fine, but at least starting that planning process to be able to work that out, I think is really important. You really want, as Mena said, you want some really clean accounts that correctly reflect the underlying profitability of the business. So when I say clean accounts, you want to really not have any Div 7A loans, intercompany loans. You want the balance sheet to be as clean as possible and really only have core business related assets and liabilities. You don't want any non-core assets or liabilities on your balance sheet. And when it comes to the P&L, you want to make sure that it reflects the true underlying profitability for that particular period. So if you've got expenses that you would normally expense this year just to get the full write-off, but the asset or the expense is going to be related to an asset you're going to use for many periods, well, you're better off to depreciate that and not write it off in that period, even if it means, you can have different depreciation rates for accounting and tax, but even if it means that you end up paying more tax, you really want to build up. There's two things that go towards a valuation multiple: risk and growth. And risk, you get to demonstrate a business has low risk by having consistent results and consistent underlying profitability, and that's what you really want. And then growth, you want to be able to show growth in both the top line, so in terms of revenue, but also the bottom line in terms of earnings as well. The next thing to think about is, whether you will hang around in the business post-sale, because a lot of purchasers will be keen for that, just to ensure a nice smooth transition of the business and to ensure that clients and customer revenue is retained, staff are retained, and the business continues to perform post the sale just as it had done prior to the sale as well. But the problem with that is, you're probably unemployable after being self-employed for many years, just like me. I'm unemployable. So do you want to work for a boss? Are you happy to do that? I mean, you're probably not happy to do it, but are you willing to do it for a period of time? And what does that look like? Then you've got to think about staff and client communication as well. I mean, if you want to maximize your sale price, what you need to do is be able to communicate to that potential purchaser all the steps that you're going to take to ensure that, as I said, the revenue and profitability of business continues beyond your ownership. And if there's one thing in life that's free, it's professional advice, because good quality professional advice always generates more value than it costs. And it's not something to really skimp on. So, you want to involve your holistic accountant as soon as possible. Make sure, everything's heading in the right direction. You want to have lawyers. There might be business brokers, valuers, these sorts of people that on your team to be able to help you sort of maximize that exit value.
So just to recap, the first podcast we spoke about the transition strategy, which is the sort of the gradual people-focused sale, where you sort of gradually sell down your business. It's binary, it's clean. There's a lot of benefits of doing so. And the secondary one, which we just spoke about, is around a full sale and sort of establishing what is important to you before you actually sell the business as a whole. So the key message, I think, between both podcasts is around the earliest that you start, the more options you have. So no one goes out saying that they want to sell their business tomorrow. There needs to be a long sort of thought out and drawn out process. Consult your holistic accountant and advisors as to how to maximize and get every cent you can out of your business sale. Until next week, bye for now.